If we want to perform a valuation using discounted cash flows, either we can use Gordon's dividend growth model or the free cash flow method, which we have already looked at. And in addition to that, for the level 2 students, we can also use the EVA or the MVA model. Now guys, EVA stands for economic value added. MVA is then market value added. Now, this hasn't been tested before, but it is included in your prescribed textbook, so I have to cover it because there is a chance that it can be examined. So first, if you look at the framework that I've provided you with, you're going to see that the calculation is very similar to the free cash flow method. First, we need to calculate our adjusted WACC, and the reason for that is because we are going to use the WACC as our discount rate. Now, this is exactly the same as what we saw with the free cash flow method. You need to refer back to your lecture notes on cost of capital for the calculation of WACC. And please remember, if we do use the WACC of a similar listed company, we then need to adjust for entity level differences. So if the company we are valuing is more risky, we need to adjust the WACC upwards. And if the company that we are valuing is less risky, we need to adjust the WACC downwards. All right, that's exactly the same as what we saw with the free cash flow method. So the WACC is going to be used as the discount rate to calculate the present value of the forecast EVA. So in step 2, we are now going to look at how you calculate this forecast EVA. Then once we have the forecast EVA, we'll use this WACC from step 1 in order to calculate our present value. So in step 2, calculate the EVA for the forecast years. Now once again, this is the same as the free cash flow method. We are only looking at forecast years in our calculation. You don't look at prior years, you don't look at the current year. You only include forecast information in your calculation. Then how do we calculate EVA? Adjusted net operating profit after tax, and we deduct our adjusted capital employed multiplied by the weighted average cost of capital. So how do we calculate, firstly, this adjusted net operating profit after tax? And then after that, we'll look at the calculation for capital employed. So first, please note this is net operating profit after tax. So if it's your operating profit, it does not include interest because interest is not an operating cost. So this is before interest. And then also, this is after tax. But please note, it's not the tax expense on your statement of profit and loss and other comprehensive income. It's the tax that is actually paid. So again, that's exactly the same as what we saw with the free cash flow method. So that's the starting point. We get our net operating profit after tax paid. Then we need to make certain adjustments to net operating profit. First, any accounting depreciation that we have is added back. And instead of looking at accounting depreciation, we use economic depreciation. And economic depreciation is just the change in the market value of the asset. So add back any depreciation and deduct the change in the market value of the asset instead. Then, if there are any expenses that create an enduring benefit, so they have a value over a term that is longer than 1 year, we don't expense those costs in this year. Instead, we capitalize those expenses and we write them off over the period that we expect to receive the benefit. So an example is advertising, training, research and development costs. Don't expense the full cost in the year that it's incurred. If we believe that we will get the benefit from this expense over the next 3 years, then we capitalize the cost and we write it off or expense it over the 3-year period. All right. Then if we have any non-cash items, we need to add those back. So for example, depreciation or any increase or decrease in your provision for bad debts, because obviously that's also not a cash flow. And the purpose behind doing this is we are trying to convert our accounting profit into cash flows. So similar to the free cash flow method, we want cash flows. So anything that is not a cash flow must be eliminated. So linked to that, if we have any movements in deferred tax, that must also be eliminated because that is also not a cash flow. We are trying to calculate the tax that is actually paid during the period and not the tax expense from our statement of profit and loss and other comprehensive income. So that deals with the calculation of the adjusted net operating profit after tax. We now need to calculate our adjusted capital employed. And please note, capital employed is either the value of debt plus equity, or you can take your operating assets and deduct your current liabilities. Whichever way you perform the calculation, you should get exactly the same answer because that's why our statement of financial position balances. So let me quickly explain this in a bit more detail. If we look at a simple statement of financial position, we have non-current assets, we have current assets giving us total assets. We then have equity, non-current liabilities, and current liabilities. So if I want to calculate capital employed, either I can just add together the value of my debt and my equity, and that gives me capital employed, or alternatively, I can take my total assets and I can deduct my current liabilities, and that will give me exactly the same answer. And when performing this calculation, you should use replacement values or market values of assets instead of historical costs. So don't just take the historical cost or the carrying value from your statement of financial position. Instead, rather use market values or replacement values if possible. So what you're going to do here is you are going to calculate EVA for all of the forecast years. So you aren't just going to perform the calculation for 1 year, but for all of the years that you've been given information for. So in other words, if you've been given forecast information for the next 3 years, you are going to calculate EVA for each of those years. Right. Now please note, what does EVA tell us? It's the economic value added. Remember, if we calculate a positive EVA, that means value has been created. And if we have a negative EVA, that means value has been destroyed. Because if you look at what goes into this calculation, we are comparing our actual return to the minimum return that our investors want. The WACC represents the minimum return that investors want. So if we take the value of debt and equity and we multiply that by our WACC, that gives us the minimum return. We compare that to our actual return. If it's positive, value has been created. If it's negative, value has been destroyed. So you are going to perform that calculation for all of the forecast years. Then in step 3, you are now going to calculate your MVA, or your market value added. And in order to perform this calculation, first we are going to get the present value of the EVA that we calculated in step 2. And when we calculate the present value, we are going to use the WACC as our discount rate. So in step 1, we already calculated the WACC. So all we're doing now is we present value the EVA that we calculated in step 2. And when we calculate this present value, we use our WACC as the discount rate. So we now have the present value of the EVA for the forecast years. Now remember, this can't be the value of the company because this is just the excess value that is being created. EVA cannot give me the total value of the company. Look at your formula. We are comparing the actual return to the minimum return that our investors want. And this is either the surplus or the deficit. It can't give us the full value of the company. So what we need to do is we take the carrying value of capital employed. So we take the value of debt and equity from our statement of financial position, and to that we add the present value of our EVA that we've calculated. So this gives me my carrying value of capital employed. Then we add the excess value that has been created. Obviously, if it's a negative amount, that means value has been destroyed and it will reduce the value of the company. If EVA is positive, value has been created and it will increase the value of the company. Then lastly, in step 4, we are going to bring everything together and calculate the value. So we start with the market value of the business enterprise, or the MVA, and this comes directly from step 3. So whatever we calculated in step 3, you slot that number in over here. Then the rest of the calculation is identical to the free cash flow method. After that, we are going to add or deduct any excess cash balances. So remember, excess cash is not operating in nature. If the cash is used for working capital purposes, then you won't include it in your calculation over here. Okay, so if cash is used for working capital purposes, then don't include the cash balance over here. However, if it's excess cash that is not operating in nature, then we include the balance over here. Please do this if the question is silent. Then if we have any other non-operating assets that we valued separately, like investments, you bring in the value of those non-operating assets over here. That gives us the overall firm value, so the total value of our assets. If we deduct the value of debt, we will then be left with the value of equity. Then once we have the value of equity, we need to consider our owner level or our shareholder premiums and discounts. And exactly the same as the free cash flow method, the value that we have calculated over here reflects the value of a controlling interest. So even if we are valuing a controlling interest, we will never add a control premium because this value already reflects control. So you can see that discussion over there. However, because this value reflects control, if we are valuing a minority interest, so for example, we are buying 20% of the shares in the company, we are then going to need to deduct a minority discount. Then, if we are dealing with a PTY Limited or any company where the shares are less liquid or more difficult to sell, we deduct a marketability discount. And lastly, we consider if a BEE lock-in discount must also be deducted. After taking all of that into account, don't forget to multiply by the percentage shareholding that you are valuing. So if you are valuing 20% of the shares, take this answer over here and multiply that by 20%.